If you're watching this before June 5th, then the Bank of Canada hasn't met yet. But if you're watching it after June 5th, then they have met, and there's one of two things that could have happened. They either lowered interest rates or they basically said we're going to lower them sometime in the near future. And pretty much all economists across Canada agree right now that it's going to be one of those two things. But regardless of when you are watching this video, it doesn't really matter because for fixed rates, it probably isn't going to change much because the market's already priced the rate decreases into the bond yields, and the bond yields affect the fixed rates, which I'll get to in a minute. And if variable rates changed or the Bank of Canada did make a change, well, it just adjusted variable rates by a small amount. I probably shouldn't do that motion in public. And in this video, I'm going to talk about everything that's happening. I'm going to give you an update on fixed rates, which, like I said, probably aren't going to change very much in the next couple of weeks. And I'm going to talk about why economists are thinking that the Bank of Canada could lower interest rates or indicate that they're going to, and how that could potentially affect you. But before I get into it, my name is Nolan Matthias, and if you want the latest Canadian real estate and finance news, this is a place for you. So hit the subscribe button and hit the like button so more people like you can see this video. And if you're saying, hey, Nolan, I'm looking down and I already subscribed to your channel, but I'm not subscribed, what the heck is going on? Well, that is because this channel is now dedicated to Canadian real estate, and the other channel, the bigger channel, which I recommend you subscribe to as well, is now dedicated to more general economic principles, terms, explainers, and worldwide economics. So double check, make sure you're subscribed. And by the way, if you want to get my book, Mortgage Secrets, for free, which I will talk about later on in this video, you can go to mortgagesecrets.ca. It will give you all the tips and tricks to negotiate with your bank, to get a lower rate, to negotiate with your broker, and understand exactly how much room there is in a mortgage to negotiate, and what, by the way, you get for getting a lower rate. Because just like everything else in life, you get what you pay for. And if you get a cheaper mortgage, you're actually getting a cheaper mortgage. So let's get into it and discuss the Bank of Canada and interest rates. And I'm going to start by just showing you the headlines. This is leading up to the Bank of Canada rate announcement. And as you can see, there's several that are talking about the fact that the Bank of Canada is expected to reduce interest rates, or at the very least, signal interest rate cuts if you look at that one on the bottom. And this is largely to do with the fact that the GDP numbers are now getting lower, inflation seems to be back in check, and it just seems that all the economic indicators are now indicating that it's safe for the Bank of Canada to lower interest rates. Now, obviously, this has effects on the Canadian dollar and a whole bunch of other stuff that comes into play. So there's no certainty that the Bank of Canada is going to lower interest rates, but it could be a real possibility that they start to indicate that those cuts are coming soon, which I think will have a lot of Canadians very, very happy. Now, if you're in the market for a house or a property, this is going to lead to people entering the market. The amount of people that enter the market is hard to determine, but expect that if it looks like there are lower interest rates on the horizon, that the real estate market is probably going to start to pick up, at least in some way, shape, or form. Now, as I mentioned in the intro, the bond markets have already priced in rate decreases. And if you take a look at the bond market, you can see that leading up to the Bank of Canada decision that's coming in a couple of days, well, the bond market yields have gone down. So interest rates have gone down, but they've only gone down slightly, and they likely will only go down a little bit more if the Bank of Canada does indeed lower interest rates, or they do indeed indicate that they're going to. And this is because these interest rates, these 5-year Government of Canada bonds, have for a long time been priced at pretty much this level. They've fluctuated a fair amount, but they've stayed kind of within this band. And that is because there is an expectation over the next 5 years that the economy is going to find itself in a situation where we can support lower interest rates once again. Now, they aren't going back to where they were in 2021 and 2022. That's probably not going to happen unless there's some sort of surprise economic crisis, in which case it does become a real possibility. But there is a high likelihood that we'll see interest rates in the 6 to 5% range on variable rate mortgages sometime in the foreseeable future, again, assuming that nothing surprising happens. Now, of course, there's the opposite. Something surprising could happen with inflation and things could get worse, and then we could see higher interest rates. So don't bank on the long-term projections of economists, the bond yields, or anything else. The most important thing when it comes to selecting a mortgage is making sure that the mortgage you get is going to be one that's affordable for you. And if you're getting a variable rate mortgage, making sure that you also get a mortgage that you can handle should interest rates go up substantially, like unfortunately they did in 2023. And by the way, in 2020, 2021, 2022, all the indicators suggested that they shouldn't go up as much as they did, but there were surprises in the economy, like ships getting stuck in the Suez Canal and China not reopening its borders that led to higher inflation and a whole bunch of issues that were unforeseen. And unforeseen issues will cause changes in the economy, and changes in the economy will lead to unexpected things to happen with interest rates. So you need to plan for the worst, hope for the best, and make sure that the mortgage that you get when you get it is affordable no matter what happens. Now, on top of that, if you end up getting a fixed rate mortgage, you also want to make sure that your mortgage has the flexibility so that you can get a lower interest rate if rates go down. And that means minimizing your payout penalty risk, which means not getting a mortgage from a B lender, or in other words, a bank. Because contrary to popular belief, the banks don't have the best mortgages. The reason why is because all the other institutions that compete with them for mortgage business who aren't household names, well, they simply wouldn't exist if they didn't have better mortgages. And the biggest risk when it comes to getting a mortgage at a B lender or a bank, yes, I'm rebranding banks, B lenders, B is for bank, which is the backloading of the mortgages and making them expensive to get out of if you need to get out of them. And statistically in Canada, most people won't make it to the fourth year of their mortgage, which means that if you've got a mortgage with a high penalty and you need to inevitably pay it out, you're going to have those fees. And the irony of this whole thing is that 15, 20 years ago, the banks were so adamant about mutual funds and back end loaded mutual funds that basically made them more expensive. And they were the biggest opponent of those types of mutual funds. And now on their mortgages, they're doing the exact same thing that they were so against 20 years ago. And don't get it twisted on this. The banks are there to make profits. They're not there to have your best interest at heart. They're there to secure your deposits. But if you're a depositor, you're a depositor. If you're a borrower, you're a client. And they make their money off of their clients, not off of their depositors. So keep that in mind as we start looking at these interest rates. Now, I'm going to start with the 5-year fixed full feature mortgages. These are the mortgages that have the best payout penalty options. They have the best prepayment privileges, and they're from non-bank lenders, which, like I said earlier, have to have better mortgages because if they didn't, they wouldn't be in business. And I'm not saying this just because I'm a mortgage broker and we deal with these lenders. We also deal with several banks. I'm saying this because the hard truth is that these mortgages are better than what the banks offer, with the exception of if you're looking for a line of credit or something like that, which in those cases, it can make sense to go to a bank. But it's right mortgage, right client, and making sure that the mortgage that you have has the features that you need. So the best rates on the market for full feature mortgages, these are ones that you can get out of. You could potentially get a lower rate down the road because they have lower payout penalties. The insured mortgages are priced right now at 4.99%. Why are the insured mortgages the lowest cost? Well, that is because they have the lowest risk to the bank. If you default on these mortgages, you've paid for mortgage insurance through a company like CMHC or Sagan or Canada Guarantee. And therefore, if you default, the banks are covered. So therefore, the rates are the lowest. Then when you get to 35% down, you start to see similar risk profiles, and those rates are pretty similar as well. But as you start to put less down and you get up to that 20% threshold, which used to be where you got the best rate, but now is the mortgage that has the most exposure for the bank because it doesn't have insurance and it has the highest loan to value, or in other words, the highest mortgage compared to the price of the property, well, that's where you start to get mortgages that are more expensive. So when you get to 30% down, you're looking at 5.09 right now for a full featured non-bank mortgage. When you get to 25% down, you're looking at 5.14%. And at 20% down, you're looking at 5.24%. Now, there's one other category of mortgages that are even more risky, and they are priced accordingly as well. And these are what are called uninsurable mortgages. The bank can't even get insurance on the portfolio for these. And what these are is mortgages that are being refinanced, mortgages that are $1 million plus, or on properties that are worth $1 million plus. I should clarify that. Or mortgages that have 30-year amortization. So if you need a longer amortization to get a lower payment, well, you're going to pay a little bit more because these equate to riskier mortgages for the banks. And as you can see, they're priced at 5.49. Now, on the full featured mortgages, this is the one rate that has come down since the last rate update. So things are getting a little bit better from this perspective. Now, moving into the 5-year variable full feature mortgages, prime right now, as I'm filming this, is 7.2. It could very well be 6.95 by next week. So basically what you do is you take the discounts I'm going to show you, subtract them from the prime rate, whether it's 7.2 or 6.95, and that gives you the actual face rate of the mortgage. And again, insured mortgages have the best rates. So next week, if rates have gone down, you're going to see rates at 6.05. If they haven't, you're going to see them at 6.3%. Then at greater than 35% down, same rate. 30% down, you're looking at prime minus 0.75. 25% down, you're looking at prime minus 0.6. Same rate for 20% down. So for some reason here, the way the banks are pricing these right now, whether you're putting 20 or 25% down, they're looking at you as having the same sort of risk profile. And then when you start getting into the uninsurable refinances, properties over $1 million or 30-year amortizations, looking at prime minus 0.25%. So even if interest rates come down 1%, it still doesn't make sense to take a variable rate, because even if they come down that full percent, you would be pretty much even with what the fixed rates are. And then you're actually going to have to get rates to go down even further over the next 5 years to make up for all the time that you spend paying a higher interest rate. So the rule of thumb is always take the lowest rate that you can get at the time that you get the mortgage. Right now, that means a 5-year fixed. In the future, it could mean a 5-year variable. But as of right now, the variables just don't make a ton of sense unless, and this is a huge unless, you plan on paying the mortgage out within the term, in which case the variable rates quite often, especially in an environment where rates are going down, have lower penalties and therefore can be more economical if you know that you're going to have to pay the mortgage out. However, it definitely doesn't make sense to take a variable over a fixed right now, thinking that you're going to end up with a significantly lower rate than what you can get on a fixed somewhere in the 5-year term. It's possible, but it's unlikely at this point. Now, this is where we get into the discount rates. And like I said before, I talked about the fact that you get what you pay for. And discount rates always come with a catch. It can be a higher penalty. It can be the inability to pay out the penalty and switch to a different lender if you decide you want to do that midterm. They have what's called a bona fide sale clause, which means you can only get out of the mortgage if you sell the property. And these types of things become problematic when the opportunities arise to get lower interest rates. And that is a very real possibility over the next 3 to 5 years, that there could be an opportunity to get a lower 5-year fixed rate midterm if you've got the flexibility in your mortgage to be able to do that. And I can't emphasize enough that if you've got a mortgage with a big bank, you're not going to be able to do this. In fact, in 2020, 2021, there were a whole bunch of clients we were able to move from higher price mortgages to lower price mortgages and save them a bunch of money. But there was one type of person that we couldn't help, and that was somebody who had a discount mortgage. So keep in mind, you get what you pay for, and where you might save 0.5 or 1.5 or 0.15%, sorry, you may find yourself in a situation where you end up paying more because you've got a massive penalty and can't take advantage of lower interest rates. So it's not always about the rate. It's often just as much about the product. In fact, we always say product, penalty, price in that order. You first want to assess the product, then you want to assess the penalty risk, and then you want to look at the price. And when you understand the differences between the values of the different types of mortgages and the actual amount that you save when you get 0.15% off, which is basically a cup of coffee a week, depending on the size of your mortgage, it might be a nice one, or it might be a Tim Hortons. But at the end of the day, it's about that cost per week. And when you think about it from that perspective, and then look at the fact that it could cost you 15, 20, 50, we've seen penalties as high as $70,000. Well, it doesn't always make sense to take that lower rate just because that's the thing that you've been taught you should be looking for. So insured mortgages on these, I'm not even going to go through them all. If you want to pause this and see what they are, go ahead and take a look at that. But at the end of the day, most of our clients, when they understand the difference between a discount and a full featured mortgage, and they see the difference in the rates relative to what it could cost them if they end up in a situation where they have to pay a penalty, well, they typically don't choose these. So here are the variable rates as well. And again, you can pause on these if you want to take a look at what they are. But at the end of the day, it comes down to getting the best product with the lowest penalties at the best price. And if you look at the features of your mortgage in that order and pick based on that, well, over the long run, you'll definitely save a ton of money. Oh, and by the way, there are a lot of mistakes people make when they go to get their mortgage. Just take, for example, 2020, 2021, when everyone went for variable rate mortgages, but didn't understand that the variable rate mortgages at their bank were different than the variable rate mortgages, the adjustable payment mortgages that I was talking about on this channel. So you have to be careful to understand that you don't do this every day. There's a lot of stuff that you probably don't know that you don't know that you don't know. And having a good broker who has your best interests at heart and has a fiduciary duty, most provinces regulate their mortgage brokers to have a fiduciary duty to their client and make sure that the client gets the best mortgage for them. Well, if you don't have that, you're taking a risk. Oh, and if you want to see a video on the typical mistakes that people make when they get their mortgage, or if your mortgage is coming up for renewal and you want to see the mistakes that people make when they renew their mortgage, make sure you check out one of these videos right here.